Hi everyone, welcome back to another episode of Phillip Futures Trading Podcast. My name is Liao and today I'm with my colleague Trent. He's a senior dealer with Phillip Futures. How are you doing, Trent?
I'm feeling good today.
Okay, good to hear that. So today our topic is which stocks to pick during high oil price. Recently, there has been a rally in the energy market starting from the power shortage in China as the nation aims to reduce carbon emissions to the natural gas shortages in the Europe as a result of short supply from the Russia. On top of all these events, natural gas prices have also rose up to multi-year highs, with one-third of the petrol stations in the UK said that their oil tank were running empty. So whereas in the Malaysia market, Bursa Malaysia Energy Index had climbed up to more than 10% since the beginning of October, mainly driven by the increasing oil price. So now, without further ado, let's discuss our topic for today. So Trent, can you brief us on the recent rally in the energy markets and Bursa Malaysia Energy Index?
Okay, thanks, Liao. So oil headed for a 7 weekly gain, the longest run since December, as a global energy crunch roiled markets from Europe to Asia. So NYMEX WTI crude oil rallied from $60 in August to almost reaching the $80 mark currently. Similarly, in oil's Brent crude oil, the prices had gone up from $65 in August to around $82 currently. Back at home, our Bursa Malaysia Index Energy had gone up by more than 10% from 700 level in August to around 780 level currently. So there are actually a few factors contributing to the rally in energy market around the world. Firstly, the economic recovery from the pandemic, along with a supply disruption in the Gulf of Mexico following Hurricane Ida, had already tightened the market before rising natural gas prices spur additional demand for oil products like diesel and fuel oil. The squeeze, which is being exacerbated by higher coal prices, had come ahead of an expected increase in fuel consumption over the winter. In addition, oil prices also advanced after the US Energy Department said that it had no plans at this time to tap the nation's oil reserves. That followed remarks the day before from the Energy Secretary that releasing strategic stockpile was being considered to counter surging gasoline prices. While Russia is offering some form of respite to Europe with increased natural gas flows, China is still facing power outages, and Beijing has ordered its state-owned firms to secure energy supplies for winter at all costs. China fuel oil's futures jumped almost 10% on Friday as local markets resumed after a week-long national holiday. Indian refiners are cranking up operating rates toward full capacity thanks to a rebound in domestic consumption and the energy crunch, which is combining to stoke demand for diesel. Most state-owned companies now plan to run their refineries at near full capacity this month. Lastly, Moody's said underinvestment in supply will be a key theme in the oil market in the medium term as exploration and production companies continue to keep disciplined spending on new supply and are expected to continue doing so in 2022 as well. It said the upstream sector will still shows capital spending restraint, which will limit production growth in 2022 when demand is set to continue recovering and even exceeding the pre-pandemic levels. Overall, the recovery in demand coupled with an undersupplied energy market had pushed the energy prices higher.
Okay, what an insightful analysis. So what's your view to the market with the energy crisis at hand? Will it pose the risk of stagflation?
Okay, so in my opinion, perhaps it's a bit too early to forecast a stagflation, but definitely the energy crisis will pose slower economic growth in the near term. For instance, economists have already warned of slower growth in China. At Citigroup, a vulnerable index indicates that exporters of manufacturer and commodities are particularly at risk to a weakening Chinese economy. Neighbors like Taiwan and Korea are sensitive, as well as those metal exporters such as Australia and Chile. And Key trading partners such as Germany are also somewhat exposed. Beijing has been scoring for power supplies as it tries to stabilize the situation. The impact on the global economy will depend on how quickly those efforts bear fruit. Many factories reduce production for this week's Golden Week holiday, and economists are closely watching whether power shortages will return as they ramp up again.
Okay. So can you perhaps name a few stocks that we should put into our watch list?
Okay, there is actually a few energy-related stocks that investors can include in their watch list. Firstly is Bumi Armada. Armada registered second quarter core earnings of above expectation due to better than expected performance from its FPSO segment and also higher vessel availability. Armada's consistently strong earnings is expected to continue in the foreseeable future as first half 2021 net operating cash flow has improved by 187% year-on-year. So the higher oil prices of late would also ease its asset monetization process for its OMS business to repay its debt. Armada's joint venture with Sapurji Palonji Oil and Gas is also expected to commence operation in 2022, despite impending delays due to COVID-19, which could boost its profit in the near future. Okay, then the second counter will be Dialog. Dialog will continue to be one of the key beneficiaries of Pengerang's development due to its exposure in tanks terminal, EPCC, and maintenance services. Dialog announced that it has entered into a joint venture agreement with Morimachi Technology and service company to collaborate and provide one-stop engineering and fabrication service of critical process and equipment, pressure vessels, and modular plant and facility solutions to serve local and international customers from Dialog's facility in Pengerang. Total investment is estimated to be around 14 million and is expected to contribute to Dialog's earnings from 2023 onwards via its JV company share of profit, contribution, and utilization of existing infrastructure and facilities in Pengerang. However, the commissioning of the extra capacity from the tank terminal expansion are expected to add towards Dialog's recurring income. Okay, lastly, the third stock is Yinson. Yinson recently entered into an exclusive negotiation with Inuata for the Atlanta Phase 2 FPSO. A formal contract award is expected to materialize by first quarter of 2022, which will further boost Yinson's order book to around $12 billion, consisting of 8 FPSO. The group is also eyeing potential bidding opportunities in Vietnam and Angola, as well as secure pre-FEED contracts for the 2 of the Total's project in Angola and Suramani. This aside, Yinson is still in active bidding projects in Limbayong, Sabah, and Penang, Guyana. Meanwhile, on a longer term view, Yinson could be one of the more promising names within the local oil and gas space in terms of energy transition, with the group eyeing to achieve a total renewable energy capacity of 3 to 5 gigawatts in the coming years.
Wow, okay. Thank you for the fantastic stock recommendation. Okay, so now as Phillip Futures, because Phillip Futures, we offer CFD products. So can you tell us more on how can we take opportunities using CFD products when it comes to stock trading as compared to buying ordinary shares?
Okay, so the 3 stocks that I mentioned previously, investor can actually invest through Phillip Futures share CFD product. Okay, so what is contract for difference? CFD actually allow investor to speculate on future price movements of the underlying asset without actually owning the underlying asset. It's a tradable contract between investor and the CFD provider who are exchanging the difference in the current value of a share and index and its value at the contract's end. There are actually many advantages of investing in share CFD as compared to investing through ordinary shares. The main advantage is that CFDs are traded on leverage. The capital outlay to open contracts will be only a fraction of the market value. Lower margins allow traders to have a higher buying power, thus optimizing investor capital. For instance, if investor wish to invest in 100,000 ringgit worth of shares, the capital needed is only 10,000 ringgit for a share CFD with 10% margin requirement. In addition, CFD allows short selling for any duration you wish. As opposed to buy low and sell high, investor can now sell first, and when the price is high, and buy it back when the price drops, and vice versa. In other words, it gives investor a flexible investment tool.
Okay, so seems like CFD product is very attractive tools for investor and traders. Okay, so thank you very much, Trent, for your sharing. So now, if our audience out there, if you would like to know more about CFD trading or CFD products, you can drop us a message or give us a call, and our representatives are more than happy to be in touch with you. Also, you may also want to find out our ongoing promotion like Phillip Star Trader, where you can accumulate points and be entitled for wonderful prizes and cash prizes. Okay, so now we have come to an end of our podcast. So thank you, Trent, for being here today. So I will see you next round.
Okay, thank you. Bye-bye. See you
Thank
again.
you. See you.